In 2026, the average American household carries $105,000 in debt, not from reckless spending, not from bad decisions, not from living beyond their means, from a system that was built over decades to make escaping debt harder than most people realize. We are now $18.79 trillion in household debt. That is not a typo. By the end of this video, you will understand how this happened, the 3 layers of the machine behind it, and why so many Americans feel trapped no matter how hard they work. To understand the machine, you have to go back to 1978. Before then, every state had usury laws. These laws limited how much interest banks could charge. They existed for one reason: to stop lenders from exploiting people when they were desperate. Then came the Marquette decision. The Supreme Court ruled that nationally chartered banks only had to follow the interest rate laws of the state where they were headquartered, not the state where the borrower lived. That single decision changed everything. South Dakota removed its interest rate caps and invited major banks to relocate. Delaware followed. Other states followed after that. A race to the bottom began, and the modern credit card industry exploded. The machine operates in layers. Layer 1 is the credit card system. Right now, more than 100 million Americans carry persistent credit card debt. Total balances have reached historic highs, and interest rates remain painfully expensive. But the most powerful part of the system is not the credit card itself. It is the minimum payment. Imagine your car breaks down. You put $5,000 on a credit card charging more than 20% interest. A statement arrives. The minimum payment looks manageable. $75, maybe less, so you pay it. That is exactly what the system expects. What most people never calculate is how long that debt survives when only minimum payments are made. A $5,000 emergency can follow someone for nearly 2 decades. By the end of that repayment period, thousands of dollars have been paid in interest alone. Legal scholars have a name for this model: the sweatbox. The borrower stays trapped. The interest keeps flowing. The system extracts value month after month from people who are already struggling. And the industry has another term, a term for customers who pay their balance in full every month. We call them deadbeats, not because they are irresponsible, because they are not profitable. The profitable customer is the person carrying a balance, the person making minimum payments, the person paying interest month after month. That is the ideal customer, and entire business models have been built around producing more of them. Consider what this looks like in real life. A disabled woman living on Social Security accumulated a credit card balance of $1,963. She fell behind. Over the next 6 years, she paid thousands of dollars to her lender. Yet fees continued accumulating. Interest continued compounding. By the time the process ended, she had paid far more than she originally borrowed and still faced legal action over a balance that had grown instead of disappeared. More than 40 million Americans carry student debt, but the amount owed is not the most important part of the story. The real story is what happens when borrowers cannot repay it. In 1976, student loans could still be discharged through bankruptcy under certain circumstances. Over time, Congress restricted that path. The waiting period grew, the restrictions expanded. By 1998, federal student loans had effectively become permanent obligations. In 2005, similar protections were extended to many private student loans as well. Think about what that means. A failed business can go bankrupt. A failed investment can go bankrupt. A failed real estate venture can go bankrupt. But educational debt can follow someone for decades. Courts often require borrowers to prove extraordinary hardship before relief is granted. In practice, that standard is so difficult to meet that very few people ever succeed. The result is a form of debt unlike almost any other. And then there is the number that shocked critics. The government created repayment programs that promised eventual forgiveness after decades of payments. Millions enrolled. Millions followed the rules. Millions waited. Then a review examined how many people had actually received cancellation. 32 people, out of millions. 32. That statistic became a symbol of how difficult relief had become. A program presented as a path out of debt had delivered almost no exits at all. Now we arrive at the most important question. Why did Americans accept this? Did an entire nation suddenly become reckless? Did tens of millions of people suddenly become irresponsible? No. Since 1979, worker productivity has risen dramatically. American workers produce far more economic value than they did decades ago. The wealth exists. The question is where it went, because wages did not keep pace. Housing became more expensive. Education became more expensive. Healthcare became more expensive. Every major expense moved upward. Families found themselves squeezed between stagnant income and rising costs. That gap had to be filled somehow. Wall Street filled it with credit cards, student loans, auto loans, home equity borrowing. Debt became the bridge between wages that were not growing fast enough and costs that would not stop rising. This process has a name: financialization, an economy where increasing amounts of profit come not from producing things, but from lending money to the people producing things. That is the twist. The machine does not simply profit from debt. It depends on debt. Many families were not borrowing to get rich. They were borrowing to survive emergencies, to pay rent, to afford college, to cover medical bills, to keep up. Debt became the synthetic substitute for wage growth. That does not mean every financial decision was perfect, but it does mean the story is larger than personal responsibility. That is a different story, a darker story, and it is the subject of the next documentary, The Unsaid. We cover the stories they bury. See you in the next one.